Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Max Kettner of HSBC writing, "We don't think it's time to pull the plug on risk. We therefore add to US equities as Q3 warnings, or rather earnings expectations, also don't look challenging to beat." Max joins us now for more. Max, good morning to you, sir.
Good morning.
That's the equity call. I want to get to the credit call. There was a shift on high yield for you in the last week. You moved that overweight from max overweight to, where are we now?
Slight overweight.
Slight overweight. What was that shift
from
about?
Exciting to boring.
So what's that shift about? Let's start there.
I think, look, when we look at high yield, it's not like it's bearish. So certainly in Euro high yield, things look still pretty okay. Valuation-wise, it looks a bit more attractive. I think in US high yield, there's partly a story around valuations. You know, you have high yield spreads around 320. There's not an awful lot to go anymore. There's not an awful lot of spread tightening that you can still see. So at some point, it gets around pure carry. And then you sort of, okay, is that still the best place where I get the carry, or is other places better, such as EM local debt, for example, where perhaps, you know, you get higher carry, it's a bit short, it's sort of equal or similarly short duration, and it looks a little bit more attractive now, given how much has been priced in since April there, similar to the Fed. And I guess, you know, when we look at it from a total return perspective as well in high yield, if you get now these sort of 10, 11 cuts priced in by the end of this year, if you get just a few priced out, right? Like, let's say, compare high yield to equities then. If you're long equities now, if you're long the S&P, do you care whether they cut 10, 11 times by the end of the year, or they cut 7, 8 times by the end of next year? Not really, right? Like, that's not really the big tail risk anymore. The big tail risk, particularly in April or in September, October last year, was they're not going to cut at all, or they may even have to hike. The tail risk now is, well, maybe I'll do only 4 or 5, but they will be cutting. So for equities, it doesn't matter. For high yield, it matters, because obviously the front end of the curve goes up.
Well, doesn't it matter for EM as well? Can we get into EM a little bit more? What are the assumptions you're making on rates on the US dollar to make that call?
Yeah, I do think, however, that in EM, again, valuations are a little bit more enticing. If you look at EMD spreads in particular, you know, year to date, so they're sort of flattish. Of course, there's been some index composition changes as well. Yes, of course, but from a valuation perspective, certainly there's a bit more juice left compared to US high yield. So we're really at the stage now where it's not really bearish about high yield and much more bullish on the other stuff. It's a bit like, okay, you're really harvesting that carry. Where's the carry best across all the asset classes?
How much is this just a revival of the FOMO trade? Essentially, look for the biggest return and go. And that's essentially because the Fed is cutting rates, and so, yay.
Yeah, pretty much. I think it's sort of the, you know, we were saying in I think it was 2021, that it's all pretty much a YOLO world, right? And it was sort of the return to YOLO. You could argue that's sort of what we're seeing, for example, this week. But let's be honest, we could also sit, maybe by the end of next week, we could sit here and you guys talk about $1.5 trillion being wiped out again. Like, if we had this chat last Friday, we wouldn't be that upbeat. No, we would all be like, oh my God, is this recession? And, you know, are we closer to the end now? And is this the start of a bear market, and what is commodities trying to tell us, and all this sort of stuff? And now we sit there and we're like, YOLO, everything's great. So, you know, this is how much it shifts within a week, if we're honest.
We were having a conversation to start the show about 25 versus 50 basis points, and I wonder how much you were rolling your eyes and how much you were actually saying this is going to matter to the market.
Do you want me to roll my eyes? I don't know.
Happy European who actually can go skiing on his weekends. But I am curious about whether you are seeing a market that is likely to sell off in response to a 50 basis point rate cut, or respond with that cheer and YOLO.
Yeah, so it depends. I think they would have had the chance in the last few weeks to say, look, we're so comfortable with this disinflation picture. If they had, look, we're so comfortable with this disinflation picture, look what has happened since April this year. We've had super core down, we've had all these, you know, all these components down. So because of disinflation, we could cut higher, right? We could cut more, we could start more aggressive. The problem now is that, of course, particularly with Jackson Hole, you said, oh, we're attentive to growth risks more than inflation. So the problem is if you start with 50 now, particularly with what John was saying in terms of the data, the totality of the data, sorry, not making fun, of course.
No, of course not.
Of course not.
It's not my language anyway. Why are we blaming me for that? That's Chairman Powell. Carry on, Max.
So if we look at that, then the last couple of weeks actually has been really good. Look at weekly same-store retail sales data. It's been picking up from 4.5% to 6.5%. Now, when we look at jobless claims, you look at weekly consumer confidence data. You look at some of the electricity output. Look at the Dallas Fed's weekly economic index. Look at the GDP now from Atlanta Fed. We're talking 2.5%. So it just doesn't warrant it currently. So the risk is if you go 50 first, the market will say, what do you know that I don't? What am I missing? And I think that's what the market will take, a bit of like, oh God, I don't like this.
But Max,
I really don't like this.
Can't the chairman just clean that up in his press conference?
I think he could, but I think particularly with Jackson Hole, they've sort of missed the boat. Right? It was particularly also with Jackson Hole that they could have said, look, it's really because of inflation. It's really because of the disinflation that we're so comfortable with. That is why we could be cutting much more aggressively from the start, right? That's why we could sort of rush out of the gates and be like, we can cut 50. Yeah, growth has been a bit wobbly, but we're really comfortable with this still. It's just because of disinflation. And they sort of missed the boat on that.
Since you're visiting us from abroad, I have to ask you about the U.S. election. How concerned are you about the risks that are tied to November?
Yeah, look, not an awful lot, but because when we look, for example, at 2025, I think people talk a lot about the US election. I'm not sure how much people have positions on. Certainly when you look at our tactical asset allocation convictions, they are really not particularly tied to the US election, because I think what we're missing, looking a bit into 2025 as well, there is the debt ceiling issue looming, for example. But the Treasury has made it clear that we want to have these $700 billion stocked up in the Treasury General account in order to be able to pay that down, which could be at least perceived by the market again as temporary stimulus. Similar to what we had in Q2 last year, which is actually pretty good. Now, that's independent of the election. We know that in 2025, of course, there's a couple of those tax cuts from 2017 expiring. Again, that's independent of the election. We're going to have to deal with that. There is some sort of fiscal cliff awaiting us, perhaps second half of next year when the negotiations start. There is going to be something looming. That's independent of the elections.
Any evidence from your conversations that the Europeans are willing to de-risk from US assets ahead of all of that? Are they concerned about it?
No, not at all.
Not at all?
Not at all. I think if anything, we've seen in the last, particularly, let's call it 5 months, we've seen the opposite. I think we've had this sort of long Europe trade into April, call it April, May, long Europe, perhaps long Japan, a bit of diversifying. Oh, is the ex-US outperformance, is that really now kicking off? And in fairness, when we look at all the activity data, when we look at the high frequency data, it's really strong still in the US. We're talking about the fiscal picture, the fiscal support. It's really strong in the US. Look at what Draghi was saying this week around, come on, we've got to be supporting more, right? We've got to be supporting more. And where it's happening is here. It's in the US. So if anything, then you've got this, you had the French elections, of course, so there was these sort of concerns around that as well, whether unwarranted or warranted, don't care, but all of that really led a little bit more the inflow picture back into the US.
Max, it's good to see you here in New York. Thank you, sir. Good to catch up. Max Kettner there of HSBC. Elsewhere, Bank of America's Business Owner Report showing cautious optimism from small and mid-sized businesses as the Fed prepares to cut interest rates. Sharon Miller of Bank of America writing, rate cuts will reduce the cost of debt servicing on floating rate credit facilities. This easing of the expense environment may create cash flow capacity for expansion or investment opportunities. We're lucky this morning that Sharon gets to join us on this program. Sharon, welcome to this program. I just want to start with this one. The amount of insight that you and the team have across 1 in every 3 small businesses in America. We're worried about stress starting to build, weakness starting to materialize. What are you seeing in the businesses that you cover at the moment?
Well, you're right. We cover 3.4 million small and mid-sized businesses in the U.S., and we are the #1 lender to small business across the U.S. And so we do have a lot of insight into what's happening. In our most recent survey that we did with business owners in the spring, we found cautious optimism from our clients. And so they do expect their revenues to increase over the next 12 months. And we know that debt servicing, as you said in the opening here, will be reduced because we do expect that rates will be cut, at least our economists do here at Bank of America, 25 basis points in the next 5 Fed meetings.
So, Sharon, are you saying they've got the confidence, the expansion plans are ready, they're just waiting for small reductions from the Federal Reserve over the next few quarters?
They are, and we still see demand in the marketplace now. So I'm not saying that they're waiting entirely. There is good growth across the small and mid-sized company sectors, but they are watching that. And certainly as we see rates come down, that will improve their cash flow and certainly consumer demand.
Sharon, I got to say, I was reading this report and I was shocked, the recent report that you put out. I was kind of shocked that actually we saw such sanguine sentiment, that people were expecting to continue to hire, that they were continuing to expand. They had positive outlook for their businesses. How do you reconcile that with some of the rhetoric that we hear every single day? This is an economy that's on the razor edge of turning negative.
You know, I think with small and mid-sized companies, so we bank clients in the business banking space from startup to 50 million in revenues. And so when you have a smaller company, you're certainly more nimble. You're able to really, think about your business, your growth, and you can pivot easily. Bigger corporations may have more of a hard time doing that. And so that is a competitive advantage of small to mid-sized companies. And we see that come through in the data and just in our conversations that we're having every day across the desk from these clients.
What I thought also was striking was in the market, it seems like inflation is no longer a significant concern. We heard just a couple of days ago from Mike Wilson over at Morgan Stanley that it's dead. Essentially, inflation is no longer an issue when it comes to what you're seeing in bonds. Nonetheless, 68% of small business owners say they've raised their prices over the past 12 months. And on average, they've raised prices by 12%. They're talking about inflation as a more pressing concern than many other things that we talk about every day. How do you understand whether this is really a small business issue or whether maybe we're not giving enough credence to just how much ongoing inflationary pressure there actually is?
Well, there is ongoing inflationary pressure. It is a sticky issue. And so we continue to hear that. That is the #1 concern of small and mid-sized companies. And so you have seen price increases brought along because of all the pressure there. So I do see it as a concern. We hear it from our business owners, and we do feel that as we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
Sharon, given that pricing pressure, how difficult is it for these small companies to keep up with the bigger players?
Well, I think that, there is some difficulty in keeping up with the bigger players, but I would say that, they also have a competitive advantage. And so, as supply chains have improved and as businesses have expanded, and certainly they've gone more online, gone more digital, they have more reach and scale than they might have had before the pandemic. And so what we are seeing are expansion plans from small and mid-sized companies, and they are competing. And certainly, they benefit from the downstream impact as well from larger corporations.
We're talking about inflation. We're talking about the fact that they're preparing for these rate cuts. When you talk to clients, what is their #1 concern right now in this economy?
Their #1 concern is inflation. And then right next to that is hiring and making sure that they have the right skilled labor, the right employees to go into their business to work. And so those are the concerns that we hear every day. I mean, we're also in an election year, so you do hear that as well. But we hear that with every election cycle. We've been doing this report for the last 10 years. And so in each election cycle, we see, concerns once the election is over, no matter who wins, no matter what party, that there's certainty. And so people can move forward. And so that's what we're hearing this cycle as well. And, I anticipate after November, there'll be certainty and people will continue with their plans.
Sharon, talk to us a little bit about how things have changed since March of last year, given all the banking stress in this country and some of the banking failures as well. How some of your clients have changed the way they do business with you, whether you've managed to attract a lot more small businesses over the last 12 months worried about where they place that cash and they want to put it with a bigger institution like Bank of America. Sharon, how much has changed?
Well, I mean, I think, listen, we are the #1 small business bank in the U.S., and we're very proud of that. We have been for the last 4 years plus. And so, you know, we continue to stand by our clients in good times and bad. And certainly, you know, we every day we work to attract new clients and to retain the clients we have, because this is our mission. This is where communities meet business, and that is what we do at Bank of America. So we want to be sure that we are there for our clients. We have the capabilities they need, whether it's to transact internationally, to be able to, you know, have expansion in their business, to get a loan, to provide payments for merchants. So all of those different areas we are able to help our clients. And so we want to make sure that we're there for them, whether it be our online tools and capabilities to manage their cash flow. So we're investing in the business based on what we hear from clients and what they need.
Well, we were thankful that you managed to make some time for us this morning, and we appreciate it. Sharon, thanks for joining the program. Thank you. Sharon Miller there of Bank of America. Over the next week, a busy slate ahead with retail sales and a Fed decision next week. Tiffany Wilding of PIMCO saying we are heading back to pre-pandemic conditions. Developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Tiffany joins us now for more. So Tiffany, you've got to give us the answer. What did that conversation sound like at PIMCO this past week?
Well, I think the bottom line for us is certainly interest rates are coming down. The Federal Reserve, I think, has also been very clear about that. Powell, when he spoke at Jackson Hole, I think acknowledged the fact that monetary policy now probably doesn't reflect the underlying conditions in the U.S. economy. And if you look at the labor markets, we don't think that the U.S. economy is in recession, but nevertheless, the recent loosening in labor markets just suggests that there is some possibility for overshooting on that side. And in that kind of vein, the Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path. In September, we're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. Tiffany, tell us where you think neutral is. If they revise the path down, what is the path to? Yeah, I mean, I think that's a great question. So the Federal Reserve still believes it's between 2.5 and 3 on a nominal basis. And I think ultimately that's why they will get there, with not overnight. They're not going to move the policy rate there overnight because they're not exactly sure where it is. And when you're not sure, you want to just go slowly. Now, how slowly, I guess, is the question, and it's about balancing risks. You obviously don't want to take the economy into recession because your policy is too tight. We think a reasonable kind of baseline for them is to kind of write down a median rate path of kind of 3.5% by the end of 2025, could even be a little bit lower than that. And so that's the kind of pace, every meeting type of pace over the next several meetings to see how the economy responds, and then they can reassess and make a further decision from there.
Tiffany, we've been talking a lot about 25 basis points or 50 basis points on Wednesday. And before we get into the guessing game of how you interpret the tea leaves that have come out of a number of publications overnight, I am curious about how you will be gauging the trickle-through effect to the real economy of whether they cut 25 or 50. How will you understand how that's being sort of deployed in the real economy?
Yeah, well, I mean, I think if a 50 basis point cut is if they end up doing it, it suggests to us that, or would suggest, I think, that they're more worried about downside risks to the economy, and they want to kind of more quickly get to neutral. We've said they've achieved a soft landing. Now, really, it's going to be about sticking that soft landing and keeping it going. And I think again the question is about how quickly they know they need to get to neutral. How quickly do they get there? So that's how we would be reading. I mean, we still think a 25 basis point rate cut is probably reasonable here. We don't think the economy is in recession right now. Certainly the labor market indicators, are worrisome, but we have had this big surge in immigration that is kind of blurring the picture with some of those indicators. So, I think there's a lot of things they have to take into consideration here. And so again, 25 with a sequence of cuts that they signal seems reasonable to us.
Just what I'm trying to get at is what's going to be the actual implementation of lower rates in the economy? Will you be looking for some sort of significant uptick in small businesses borrowing? Are you going to see increases in consumer borrowing or reductions in, say, some of the delinquencies as people's borrowing costs go down? What are the sort of signs that this actually is working at a time where the efficacy of monetary policy has been profoundly questioned as rates went up? And now the question is how quickly it'll be implemented on the way down.
Yeah, I mean, I think if you look at the household sector, we've been talking a lot about this as well. Households just haven't really felt higher interest rates. Many of them have low rate mortgages that they locked in to 30-year periods during the pandemic. So the household sector probably won't feel a lot of it, unless you have new home buyers or first home buyers. But where I do think it could be potentially helpful, is in terms of housing supply. So we've all known that we've been in a period of underbuilding relative to population growth over the last decade post-pandemic or more, and that's resulted just in supply-demand imbalances in the housing market, which suggests to us that as you have rates coming down, you can have real residential investment that picks up. That's obviously going to be helpful for the economy. We think housing investment probably subtracted 1.5 points from GDP in the third quarter. That's a pretty big subtraction. So just getting that back into some modest growth we think is probably helpful. And you could certainly get that as you have rates coming down.
I'm glad you mentioned housing. There's been this debate on what actually will happen when rates come down. Will people start moving and more supply will come on the market and costs will come down? Or potentially, will we actually see housing prices go higher?
Yeah, I mean, so in terms of, the moving and the existing home sales and things like that, when people move, they usually move from one house to another. So, in terms of the aggregate supply picture from that, yes, you get more churn in the market, but it's not on net really that it shouldn't increase by that much the overall supply of homes. What increases the overall supply of homes is new building. And so that, I think, is really the key. Building, has been slow and sluggish this year because interest rates are elevated. Many builders you talk to say the economics are, make less sense with higher interest rates. And so when rates come down, we do think that, building will accelerate somewhat. And I think that's ultimately good for the economy. It's good for the supply-demand imbalances. Eventually, hopefully, that helps to moderate housing prices. Although, we don't think that they drop, housing prices will probably be, kind of 5% type-ish ranges. But again, I think that's not necessarily a bad thing for the economy.
Tiffany, and just circling back to what Lisa alluded to, some of the tea leaves that are coming out of things like the Wall Street Journal or the Financial Times, if the market is now presented with potentially next week the Fed going 50 basis points, does that mean now there's outside weight on retail sales next week?
Well, certainly I think if retail sales next week is bad, is much worse than expected, I think that would maybe potentially increase some probability. I think if you just kind of take the broader range of data that we've gotten over the last month or two, labor market data, in our minds is important, and the labor market data that we saw, it wasn't great, but it wasn't terrible either. So it does suggest that labor markets are slowing, and I think the Federal Reserve wants to try to understand what's going on there a bit more. The slowing that we've gotten over the last couple of months, I think, has been more pronounced than many people expected, both in payroll growth and, of course, the unemployment rates ticking up. So I think, they probably look at that and they say, we are a little bit concerned about that. And if you're concerned about payroll growth slowing, the labor market slowing, of course, you'd expect consumption to be slowing as well. So they probably will be looking at retail sales and those consumption indicators, to kind of confirm or deny, if you will, whether the labor market slowing is having a broader impact on the economy.
Tiffany, appreciate the update. Thank you. Tiffany Wilding there of PIMCO, looking ahead to this week. Joining us now to discuss is Troy Gayeski of FS Investments. Troy, good to see you, sir. As always, welcome back to the program. Before we get into the markets, let's talk about the Federal Reserve. What's the base case for you and the team?
Yeah, so 325 basis points cuts. We came into this year thinking 2 to 3. There was some overreaction, obviously, early on that there'd be 6. And then when the inflation data came hot in Q2, some folks were arguing for none. But, it's almost a certainty at this point that we're going to get 3 cuts. Clearly, the labor market's softened. There's no doubt about it. Inflation's gotten much more under control. That's the right policy response. And I'll tell you, when you think of credit investors like ourselves or originators of private debt, we're more than happy to trade off some degree of incremental income to further reduce the risk of a recession going forward. And so that's where we're at in the economy, and it's going to be an appropriate response. To your point before, it's now about next year and the year thereafter where there's much more uncertainty.
Yeah, much more to play for. Troy, I want to get to the quote from Tiffany Wilding just moments ago from PIMCO. When she said this, and I'd love your reaction to it, developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Troy, what's the best argument for that, do you think?
Yeah, so when you think longer term, right, arguably the biggest reason why we should have more sustainable inflation going forward than we did pre-pandemic, and particularly in the post-GFC realm, where, as we all know, the Fed was struggling just to get inflation too, it is a much globally tighter labor market, right? You think of places like Japan or even China now, declining working age population. The U.S. labor market has gotten much more structurally inefficient. So that's arguably reason number one. And then reason number two, of course, is this really desire to onshore production. Obviously, we're going through a period of protectionism. So, I think that debate is new terminal rate 2.5 or 3. We can debate that quite vociferously. However, it's certainly not 0 unless we have some type of major exogenous shock that is unforeseen.
There is this question right now of how much we can really count on just sort of inflation continuing to diminish. And I just want to build on what you're mentioning. How are you sort of countering the assumption in markets that inflation is dead in terms of more contrarian investments that push against that?
Yeah, I don't think we're arguing or most rational market participants are arguing that inflation is dead. It's just that we've made significant progress. And the balance of risks is now much more symmetric between the labor market and inflation. But in terms of counter-cyclical to that thinking, there's really nothing specific there. However, opportunistically, we have to look across markets and try to find areas where there's more inefficient pricing. So, for instance, if you look at most spread product, whether it's high-yield bonds or levered loans, and even in on-the-run private credit, spreads are relatively tight. They're a little bit tighter than they were coming into 2022. You still have very attractive yield. However, if you look over at public markets, what you're seeing is markets are pricing about a 22% probability of deal breaks in each individual deal and mergers. Historically, over 10, 20 years, it's been 5. Even in this environment, it's peaked at 8%. So we're trying to identify inefficiencies like that we can take advantage of in our liquid strategies.
I know you focus on illiquid strategies and some of the private investments. You're talking about merger arbitrage. And let's go there, because this is actually one area that a lot of people don't want to get caught dead in, just simply because a lot of these deals have been broken. And we have seen a very different FTC under Lina Khan. How can you have confidence to go in and bet that deals are going to get done now, given how politicized so many of these deals are actually getting?
Yeah, well, I think, again, that gets back into pricing. Let's say, for instance, markets are pricing in 12 or 15% probability of deal breaks, and the historical average is somewhere between 5 and 8, depending on how aggressive the FTC was or not. It would be a different story. But as an investor, you're always trying to look at market mispricings versus empirical data. And this is one of the more glaring. And we're not going to say it's an overreaction to your point, a very active FTC. It's just presenting itself with a very attractive theme over the next 12, 18 months. And I think at this point, regardless of the political outcome in November, that looks like a very attractive risk reward to us relative to other strategies out there.
Interesting. Troy, it's good to hear from you, buddy. As always, Troy Gayeski there
Great to talk.
of FS Investments. Thank you, Troy. Appreciate it.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.